I'm doing another live, and this time we're going to be talking about debt service coverage ratio loans, DSCR loans, or as I like to sometimes call them, cash flow loans. And the reason I call them cash flow loans is because it all depends on whether the property's making you money, because that's what will let you qualify for it. It's an interesting hybrid between, I guess, kind of, if you want to think about it this way, like commercial lending and residential lending. You can buy a residential property basically and have it be a rental property day one, not something that you need to occupy day one, and have its own income qualify for you acquiring it. Um, Essentially, you won't need to use your debt to income ratio, although it affects your debt to income ratio. So, without further ado, I'm gonna dive into it. A little bit of housekeeping though. If you want to, in the description, wherever you're watching this, YouTube or Facebook, should be a link. You can click on that if you want to write comments and have your name pop up and all that kind of stuff. If you do not want to, if you want to just comment, I should be able to see it anyway here in my studio, and I'll be able to answer those as I go, or maybe towards the end. We'll kind of play it by ear. But please ask any questions you might have. No dumb questions. All right. So with the crazy interest rate market out there, although I will say it's not as crazy as you might think, a lot of us, though, are a little worried about the interest rates. What it's causing to have happen is that people are just basically shying away from buying real estate. They're like, "Oh, there's so much uncertainty. I don't want to dive into this. Like, who knows what's going to happen?" I'm not going to get into all the reasons why you should still, plant those trees and start now so that 20 years you reap the benefits. But I am going to say that there is a way to do it where it's not as scary, and you might be able to get into this even if your own income isn't as high as you think you might need it to have to qualify for the property. And that is, as I alluded to before, the debt service coverage ratio loan. And we are experts at this because we're all about investing, and our lending team does this all the time. I actually did just a quick little video on our Instagram. So if you're not following us on Instagram, at Active Duty Passive Income, definitely follow. Now, so how this works and why is this something that can still potentially let you cash flow even if the interest rate is higher? Okay, let me cover one thing first. Non-owner occupied loans, right? So loans where you're not going to occupy them as the resident, right? You are buying it as a rental property basically day one, are typically going to have a higher interest rate no matter what. Even back when you could just get conventional loans on these pretty easily, the interest rate was always going to be, and I'm not a loan officer, so I'm not going to make things up, but from what my experience was, it was typically about a point higher, so 1% interest rate higher, and that's just like always true. If you're buying an investment property for the lender or the bank or whoever, it's always inherently, statistically speaking, because that's what all this is based off of, is a slightly higher risk. Because if you're living in it, presumably you wouldn't want to default on the loan in the place where you live yourself, right? You want to continue living there. With a rental property, you're a little bit less emotionally attached to it. So those interest rates are typically a little bit higher, right? The interest rates fluctuate based off of the risk to the lender. Really, that's what it comes down to. So since these are a little bit riskier, the interest rates are a little bit higher. And with these debt service coverage ratio loans, DSCR loans, they are a little bit riskier to the lenders, especially with all the stuff going on in the market now. However, what they allow you to do that hedges the risk for them and allows you to still potentially cash flow if you buy a good property, like maybe a turnkey property through Rent to Retirement, our great affiliate partner. You can find their unique link if you go to activedutypassiveincome.com/resources. What you can do is these loans can be interest only. Now, if you're not familiar with what interest only means, it's often called IO, stands for interest only. And what that means is that the loan, you know how there's typically two parts to the loan itself. I'm not talking about the whole mortgage where sometimes, taxes and insurance is wrapped into your mortgage payment. I'm talking about just the loan payoff itself is typically two things, right? It's the principal and the interest. The principal is what you're actually, the amount you actually borrowed and you have to pay that back. And the interest is the fee you're paying, for borrowing said money. Now, if you only have to pay the interest, you don't have to pay the principal, then obviously your payments are less. When you get a fresh loan, a fresh 30-year loan, typically it's roughly like 2/3 of the payment are going to be interest, are going to be interest, and 1/3 of that payment is going to be the principal. So you could basically chop off a whole third of your payment. So if you're going to have to pay $2,100, for example, um, if it's interest only, you might only have to pay $1,400 because $1,400 of that payment was interest. The other $700 was principal. That's it. And that slowly changes over time. And about a halfway or 2/3 down the life of your loan, it actually switches. You're actually paying more principal off than you are paying interest. And eventually you're almost only paying principal, and then until you finally pay off the loan. But I digress. I'm not talking about loan mechanics right now. I'm talking about this product where you're able to pay less in the beginning every single month, which gives you a fighting chance to have cash flow, right? When you run your numbers and you get to the loan that you have to, the debt service as it's called, that's one of the expenses, right? Principal, interest, right? You have to pay those. If principal doesn't exist, you have a fighting chance to have your bottom number still be positive and you still cash flow on a rental property. And that's awesome. And so that's why these properties are that's why these loans are so popular right now, is these cash flow loans, these debt service coverage ratio loans. And so what are some of the nuances behind them? Okay. Again, this is not something that you're going to be occupying. This is for a rental property. Another way that the lender will hedge their risk, so to speak, is they will want, typically, a lot of what I'm going to say is typically, this changes almost every single day. That's why I'm saying go reach out to our amazing lending team at just activedutypassiveincome.com/connect. Just click the red button, jump on a call, no strings attached, just have a conversation, strategize. But they will, the lender, right, the actual company that's lending you the money, they will want to see you having at least some kind of experience. Typically, like maybe you already own a primary residence that might fit the bill. Okay, so there's that. So that's one nuance that typically is the case. But again, everything changes. Typically, the minimum loan amount, not the purchase price, the amount you get loaned should be about $100,000 or more. And when you do a refinance, the loan to value, the amount that they'll loan to you compared to the full value of the home might be different than if you just do a outright purchase. Right now, don't quote me on this, but I believe the loan to value for purchases, refinances, and cash out is about 75% loan to value. So you'd have to bring 25% of the down payment, and then the loan would be 75% of the total purchase price or value of the property, the appraised value, so to speak. However, I have seen 15%, and I think right now you might be able to get down to 20% down payments. But don't quote me on this. Again, reach out to our lending team. They'll talk you through what's actually going on right now, today, and what you specifically can qualify for. Now, I mentioned debt to income earlier, and that is a huge piece. So every single individual, you have a debt to income ratio that is calculated by the lender when you want to get pre-approved for a loan. And all that is like, how much income are you bringing in that they can consider income? Some you could be like, oh, my grandma pays me $100 every month. They can't consider that income. Your W-2 income is typically the thing that lenders like the most. It's the most stable income that they can rely on when they're calculating risk about you. So they calculate income coming in, and then how much debt do you have? How much do you have to pay? I don't know, cars, mortgages, whatever, right? Then they calculate that up, and they look at it like, okay, how much of the income you're making do you absolutely basically have to pay in debt or in like leases or whatever? And that ratio is what is called debt to income ratio, DTI. And obviously, a lender wants you to have less debt payments required every month relative to the amount of income you're making. They want to see you be able to have a lot of your income stay with you. And you can go then do stupid things with that money if you want, or smart things, right? Investments. But they want to see you have that buffer, that margin, because that helps them know that you're not a risky buyer. Okay, so these properties, you don't have to use your debt to income to qualify for them. So a lot of times, if your income isn't really high, but you have a lot of debts, you might not be able to qualify for some loans. This loan, you should be able to. Again, there's other nuances, but it's at least easier to qualify for, because what is used to qualify your purchase is, hey, is that property going to make enough money to pay its own mortgage? If the answer is yes, and there's certain percentages and all this kind of stuff, but relatively speaking, if the answer is yes, then you're pretty much good. So that's the big thing. Again, I'm not a lender, talk to our team, but this is like kind of the big blue arrows, the big broad brush strokes, right? And these loans, like I have personally done one of these loans. I have actually refinanced on one of these loans. They're great. It's just like any other loan. You get an appraisal done, you figure out, like we actually cashed out. We did a cash out refinance. We got a house at $170,000, ended up appraising $360,000. We're able to pay back our own down payment off. We're able to leave fresh capital in as the new down payment. We're able to pay off all of our rehab costs and cash out a nice big check. I think it was like $50,000 on top of all that. So this is a great loan. Is interest rate higher? Yeah, I think that one specifically was like, hold on, close this. Was the interest rate higher? Yes, I think ours was like close to 8%. But again, it's debt, it's interest only, so the payments are not that bad, and we're still cash flowing on that property, so it worked out. And even if we would break even, heck, we just made a lot of money. Somebody else is paying off that debt for us, and it's giving us a tax break. Like, can't beat it. Can't beat it. A couple other things. The appraisal is typically going to be based off of market rents, right? And the cash flow calculation of whether it can qualify for its own, whether it can qualify for a DSCR loan, is if the long-term market rents can cover the mortgage, not short-term market rents, although those might be happening too. Maybe they're already out. I don't know. But I'm talking about long-term market rents right now. That's what typically is used to qualify for a DSCR loan. What else can we talk about? Some of these can be 30-year. Some of these can be 40-year loans. Sometimes the interest-only period is up to 10 freaking years. I think the one we did was like 10 years interest only. So again, the payments are lower for the first 10 years. I mean, if your rents don't go up in those first 10 years to then be able to cover the principal and interest payments 10 years later, you probably got a bad property. But then after 10 years, it starts for the next 30 years, I think it's principal and interest. So yeah, I mean, again, fantastic loan. And if I ever want to get a different loan on it, I can down the road, whatever. And yeah, just going back, typically you can't be a first-time home buyer, and typically you have to own your own primary residence to get these. That's a risk calculation on the lender's part. There is a minimum credit score requirement. And back to the debt to income ratio, it still affects your debt to income ratio, right? You still now are acquiring a new debt. So if you want to then go buy another property and use a loan that does look at your debt to income ratio for qualifying for it, this property if you just got a property with a DSCR loan before that one, that debt is definitely going to affect your debt to income ratio. And that's just something to think about. It doesn't mean that it's not a good deal. It's not what I'm saying at all. I love DSCR loans. I'm just saying that you got to know what's going on here, right? So let me look at some of the questions. Social comments display here. Oh, sorry. How do the rates compare to normal investment loans? Well, again, all investment loans are higher interest rate typically than a primary residence loan. And these are maybe even a smidge higher. I can't quote rates. I'm not a loan officer. But you see the balance there is like, even though the interest rate is higher, you're not paying principal. So you're good. Some of you might be like, well, wait a second. My earlier comment, like somebody else is paying off your loan. During the interest only period, nobody's paying off the loan, right? Yes. But if your objective is to acquire more assets to cash flow, and then eventually the principal payments will kick in and that'll start being paid off by your renter essentially, then that's great. Like if you still want to if you're a cash flow player, right? If your scoreboard is cash flow, this still achieves the mission, and you're still acquiring equity in the property, because as long as you bought it in a good market with good good population and job growth, over time it should be appreciating in value. There's going to be the dips, the market does what it does, but over time it's going to be appreciating in value. So you're still generating equity on top of your cash flow, on top of the tax benefits, on top of all the other awesome things that real estate brings. So there's that. ADPI is always bringing the good info. Yes, ADPI does. Thank you. Trying my best here. So that's DSCR loans. You can continue acquiring more and more properties with DSCR loans. And you can also deed these into LLCs. I did that with our last one. And yeah, that's about it. That is the basics of what a DSCR loan is all about, or also, as I like to call it, a cash flow loan. So if you're watching us on YouTube, please like, subscribe. Please share this to any socials you got. It really helps us spread the word and help more military families create financial freedom through real estate or business building, whatever. So that's what ADPI is all about. And I try to bring it as like simple, step-by-step Barney style as possible. If you guys have any other topics you want me to talk about, please drop them in the comments. We're scheduling these out on a weekly basis, so stay tuned. And I'll talk to you later. Mark Yancich is out. End stream.